Hello, and thank you for joining me, Fiona Cincotta, Senior Market Analyst at City Index, as we look ahead to the Q4 US Banks earnings preview. So, as from tomorrow, that's when earnings season kicks off with banks. We've got JP Morgan, Citigroup, Wells Fargo, and Bank of America all due to report ahead of the US Open. And then on Tuesday next week, we've got Morgan Stanley and Goldman Sachs reporting their earnings ahead of the Open. So here we'll just take a quick look at what to expect. Here we can see revenue, broadly speaking, is expected to show year-on-year growth. JP Morgan, a standout outperformer, expecting 11.8% growth year on year in revenue. On the weak link there, I would say, is Bank of America, which is looking to see a reduction in earning revenue of 2.6%. Then looking at earnings, so despite having that, broadly speaking, revenue growth, earnings, I think, are looking a little bit weak. We've got JP Morgan, who are expected to see a 0.7% decline year on year on earnings. Bank of America, again, expected to be a weak link there, with a almost 20% decline in year-on-year earnings. Also worth noting that Citigroup today did warn that they could see weak earnings, and that's because of the weaker Argentine peso and due to restructuring costs. But we'll touch on that in a moment. So this is what we're going to be watching. After a pretty strong Q3 performance, earnings in Q4 are expected to be that little bit weaker. And that's basically on the back of rising bad loan provisions and also owing to the high interest rate environment. So bad loans are expected to rise. Non-performing loans are expected to come in around at 24.4 billion US dollars. And that's combined for JP Morgan, Bank of America, Wells Fargo Group, and Citigroup. Now that figure is up substantially, up 6 billion from 2022, but it is still below the 30 billion that we saw in the pandemic era. Now, as well as bad loan provisions, we've seen higher interest rates, and that's actually had a detrimental effect on net interest income and net interest margins. And that's basically because of the increased cost of deposits. So again, net interest margins are going to be very much in focus. Also worth pointing out that several of the big banks said at the end of last year that they'll be putting money aside for a one-time charge. And that's to pay for a special assessment being imposed by the Federal Deposit Insurance Corporation, basically, as they look to recover the 18.5 billion US dollars that was used to rescue Silicon Valley Bank and Signature Bank last year. Finally, as I mentioned before, cost cutting, that's going to be something that's going to be very much in focus again. As I said, Citigroup and their restructuring charges will be also making an impact on their earnings, as they've warned us about today. So just having a quick look then at what's going on with the share prices with banks. Interestingly, despite these sort of headwinds that the banks are expected to be facing, demand for shares has been pretty high. Just looking at JP Morgan here, we can see that this is the weekly chart, that just in that last quarter of 2023, the share price surged. Obviously, that was also in line with the broader market, but it's taken the share price break above resistance there, which was the July 2021 high, broken up to a new all-time high. Just to be careful there on the RSI, which has tipped into overbought conditions. So I think any buying there, you should be done with caution. As far as support is concerned, it's that 160 level, which is the previous high from July 2021. That will be the level to watch for on the downside. Also, just here having a look at Bank of America. Now, again, this is the daily chart. Now, Bank of America has been steadily trending lower across 2023, but again, it's had that sort of strong reversal at the end of last year, took part in the rally that we saw in the fourth quarter, charged up in that rising channel. Now, what we have seen, though, is the price ran into resistance at just around the 34.70 level, has just been easing back, and it's just testing support on that lower band of the rising channel at around 33.50. If we do see a breakout of that channel, then be looking for support around the 32.50. On the upside, 35 is the level up there to be watching out for. Listen, I hope you've enjoyed what you've seen here. If you had, please do remember to give the film a like. And if you would like to receive more videos like this, then please do subscribe. Thanks very much.